Yeah. So anyway, small cap value.
Let's get back to your happy place.
It's done really well recently. I think it was like a record 5-day run, like a historical record,
Really?
at least for the Russell 2000. I just looked at the month-to-date return as of July 17th for AVUV, the Aventis US Small Cap Value ETF. It's up month-to-date, so July 17th, 8.85%, which is pretty incredible.
Isn't small growth also doing well? Not just the value
not
side,
look.
right? I saw someone
I didn't
posted
look at
that.
it.
Small growth is doing pretty well.
Yeah.
Also, yeah. Over the past, I just looked at the Morningstar style boxes yesterday for the past month, and both small U.S. small value and U.S. small growth were up about 10% over the month.
Sorry, Ben.
Not too bad. Over that same period, so month to date, July 17th, VTI, just with the Vanguard US Total Market ETF, is up 2.82%. So very significant month to date premium. Now it's still trailing year to date. Like US large growth has been insane this year. So small value still has some catching up to do. But that short burst of positive returns from small value and even in excess of large growth is always a reminder about the importance of staying in your seat if you want to capture risk premiums. And maybe think of actually, Mark, you reminded me of this with the chart. Back in episode 147, we had Paul Merriman on. He talked about his I don't know if it's his actually. Might have been Bogle's chart originally. Anyway, he talked about the telltale chart comparing U.S. small cap value returns to S&P 500 returns. It's kind of a neat chart that shows the relative performance of small cap value relative to the S&P 500. But what it basically shows visually is that small cap value going back to 1930, which when the chart starts, has tended to have really long periods where it underperforms the S&P 500, and then relatively short bursts of outperformance. But like on average, in the long run, small value outperforms, but it tends to happen in these short bursts. And and then there are these long periods where you've got to kind of stay in your seat if you want to capture those. So like as a long-term investor, you end up being better off in small cap value eventually, but getting there requires enduring those periods of relative underperformance compared to something like the S&P 500. And I pulled a quote from Paul back in that episode. He said, how many people are going to be able to stay the course when for 13 years, and there have been longer periods of underperformance, but when for 13 years, their neighbor is bragging about how much money they're making in the S&P 500. That's what they're going to have to put up with. And that's like
Now.
Yeah.
Hasn't changed. It's just as true as it was when Paul said that to us back in 2021. But anyway, this recent like historic small value or small cap in general performance is just a good reminder that those returns tend to show up in short bursts, and you got to be there if you want to capture them. I did also want to mention though that so year to date U.S. small cap value is underperforming market. In Canada though, small value is doing quite well year to date. So I looked at just year to date as of July 17th again. DFA Canadian Vector, which is a small cap value tilted Canadian equity strategy from Dimensional, it's up 13.91%. And then the Vanguard FTSE Canada All Cap ETF, just a market cap weighted Canadian ETF, is up 10.99%. So it's a pretty meaningful, and that's the Vector is not even a small cap value fund. It's just a more aggressively tilted toward small cap and value, but it's still sort of a more like a total market with aggressive tilts than it is a small cap value strategy. Anyway, so it's done quite well year to date. Even over the last 3 years, it's outperformed. Yep, so there it is, small cap value. It's back.
Patience is rewarded. Did you see the there's somebody I follow on Twitter. He goes by Jake, and his handle is Econompick. Like instead of economic, it's Econompick. Good follow, by the way. He puts out a lot of really interesting information, but he posted a chart this morning, and it's the 30-day correlation between the S&P market cap weighted benchmark versus the S&P equal weighted benchmark. So it's a rolling 30-day correlation matrix, and it's the lowest it's been since 2006. The correlation between an equal weighted portfolio and a market cap weighted portfolio is like in the neighborhood of 0.25 over the past 30 days. So the tweet was hilarious. He's like, you could have essentially diversified your S&P 500 market cap weighted risk with S&P 500 equal weight risk because they haven't been moving at all in tandem, right? And I think it just goes, I mean, it's a corollary to the small cap underperformance. Had you weighted differently to small value or even small caps in general, the performance has been like incredibly different from large cap over the past 30 days.
Yeah, it is interesting.
Yeah.
So you want to talk about one of your new friends on Twitter, Mark?
Oh, yeah.
One of your many
so
friends. You've got energy for that stuff that is beyond.
It fires me up. I don't know. Like, I think social media, like we know from looking at studies on this, that people turn to social media for advice. And there are a lot of finfluencers, if you want to call them that, putting out advice. And there's lots of good ones that have, reasonable advice, but there's a lot of really, really bad ones. And so I saw a post from somebody saying, like, why would you ever leave $100,000 in cash? Didn't you know you can generate 1% per week selling stock options on that? It's like 1% per, come on. Okay, so if you compound your money, yeah, well, of course it's compelling. It's because because it works out to a 68% annualized compound return. And so I just quickly pull up a compound interest calculator, and I think I worked it out. It would take you 43 years, starting at $100,000, to own all of the wealth on the planet. Like if you had that kind of compounding return for 43 years, starting with $100,000, you'd end up with $420 trillion in your back pocket. So you would completely consume all of the capital in the world after 43 years of these types of returns. So anyways, he was talking about option selling, and I happen to know a decent amount about option selling. And so what I've realized is a lot of these people talking about selling options for income are only considering half of their trade. And I won't get too deep into what I wrote about it. I think, Ben, you and I decided we might just do this in a separate episode coming up. But I wrote a big rebuttal basically to why that is absolute nonsense. You shouldn't expect those types of returns. And it's funny, I had a couple small hedge fund managers that run option strategies reach out to me by direct message saying yeah, no, I've been doing this systematically in a quantitative way for 18 years. And if we can get 20% consistently per year over a long period of time, we are absolutely thrilled with that. So any amateur trader promising 1% weekly return selling options, you can just ignore them with prejudice.
That's kind of Rentec type returns.
Well, that's just, of course, that's the comparison they're going to make, right? If you say nobody can do it, they'll be like, well, somebody did. It's like, okay, but I don't think you're the next,
Rentec.
The next Rentec. So
yeah.
Maybe you are.
I don't know. They didn't do that selling options either, did they?
No, they did 40 million trades a year, but I don't think they were selling options.
Cool.
Yep. We did an episode on covered calls a while ago, same kind of idea. I think we talked about a lot of the issues you cover in your thread.
Yeah. Yeah. The other strategy that people love is selling cash secured puts, which we'll get into in the episode because it can get fairly complex. But anyways, the tweet was just a breakdown of how this works and why it's absurd to think that selling options can generate that type of return over the long run. It's not sustainable. And I tagged this individual saying, hey, here you go. Because when I commented on his post, he first said, sounds like you don't know how to sell options. I was like, well, okay, now I have to write a whole thing. And so I wrote the whole thing, and then I tagged him, and then he wrote back saying, sounds like you don't know how to sell options. I was like, dude, I just wrote 2,000 words on selling options. What have you contributed here? So anyways, I'm into these Twitter spats. And I do it just because I think it's good for people to read that information, right? To kind of counter the misinformation that's out there. Not because
I agree.
I enjoy
I'm just saying,
dunking
you have
on
energy
people.
I don't have for that.
Yeah, your energy is impressive on that stuff.